Looking at South Africa,
Yes.
credit demand contracted in February for the fifth straight month, indicating fragility in economic recovery. What is your impression of the South African consumer?
Remember that often what happens is when you have an economic recovery, private sector credit extensions and credit demand and all those things is a lag effect. So there's a lag effect that's built into the numbers. So what happens is you've got to look out, not at the numbers that you're seeing today, but you've got to look at what could potentially happen to these numbers in 6 and 12 months' time. Remember that when your GDP numbers turn or when your interest rates start moving down, consumers don't immediately start spending. Consumers, it takes time for the consumer to start spending again, and that happens only way down the cycle, potentially.
So when can we see an improvement in credit demand then?
Well, why is credit demand so important? Credit demand is firstly important for the South African economy because it drives GDP, not to the degree that it drives the American economy. I think there's many other things that drive the South African economy rather than just credit demand. But I think the big thing about credit demand is the fact that it focuses on the South African consumer, it focuses on the robust South African consumer, and obviously that's good news, and it obviously filters through into the GDP numbers. You could probably look at private sector credit extensions probably only start, materializing maybe 12 months from now. The importance isn't an exact date when you start seeing credit demand again. It's looking at the factors that are at play at the market at the moment and what that potentially could mean for credit in the future and what that means for stocks, bonds and cash and other instruments and how you then build portfolios. I think that's what's important really.
And the M3 money supply, its importance to the South African economy?
Again, M3 money supply is again a sign of a robust economy. Money supply increases, it means there's demand for more cash in the system, and hence, that's obviously seen as a sign of a robust economy. Again, this is one, each of the factors that economists look at is in isolation means very little. But in conjunction with all the other ones, they paint a picture of a specific economy at a specific point in time. Again, M3 is something that you'll see only much later on in the cycle. I think it's an important thing to remember for all these numbers is that you're seeing a bottoming out effect. So you're seeing these numbers bottoming out at the bottom, and you're going to start seeing them rising again at some point.
So the 50 basis points cut by the South African Reserve Bank, looking at these private sector credit extension numbers, it was pretty justified.
It's a surprise cut, let's put it that way. Most people didn't expect a cut, 50 basis point cut. I think, there's a lot of pressure from different quarters. I think they, given the inflation numbers that came out on the day, they could cut by 50 basis points. They're still in positive territory just beyond what the inflation numbers have shown. 50 basis points, you'll have to see now what happens with inflation, because we're in uncharted territory. We're starting to see price hikes coming through for inflation. We're starting to see winter in South Africa, and various other things that could make a difference to the inflation picture. The thing that's good about the inflation picture, though, is that we're seeing very anemic inflation internationally, which obviously is good for us here in South Africa, because you're not seeing really price growth for goods internationally. So when you're importing goods, it stays relatively stable, relative to we have, to what we've seen in the past. But that can blow out quite easily again, which means that we'll start hiking rates. That's the beauty of living in an emerging market, I suppose.
Indeed. Looking at economic cycles, where are we now relative to 12 months ago?
12 months ago, you saw a complete panic in the markets. You saw complete desperation about the system, about the world. You start seeing people very pessimistic about the world. Whereas now, 12 months on, those pessimists are starting to turn into optimists. So you're starting to see people saying, well, I'm sorry, but maybe the system isn't going to be dead. Maybe we are going to see a future. And then we start asking questions such as, what could private sector credit extensions look like? Whereas 12 months ago, it was, how far can these private sector credit extensions fall? And that's important. That is often the trademark signs of a recovery in an economy. And often when you have a recovery, you look forward to growth, for quite a few years. And I think that's important to take into consideration, is that from this point forward, earnings will start growing. We already started seeing the insurers, obviously because of markets, starting to come out with some decent earnings numbers, lifting the JSE All Share total earnings. And we're going to start seeing some more of that happening, going forward. It might be a slow recovery, but it'll be a recovery in earnings, that drive prices, in the JSE All Share, going forward.
market is also winding down the first quarter. What was your impression of the first quarter of 2010?
It was fairly choppy. You know, we saw the market buying up quite aggressively, and then all of a sudden people realized, well, like, earnings aren't following, and we're waiting for, you know, the flurry of earnings coming through from December, and then we saw markets selling down. And then all of a sudden, you know, as they saw that things weren't getting any worse, especially with the top 40 companies, we started seeing markets, you know, appraising again. The point, the difficulty though, is that from the high point that we saw in the market in June 2008, you know, we're only about, you know, 12 to 13% off that high point. You know, it's not like, you know, I mean, we might have had this massive chasm in the middle, but it's not like if you've just been a long-term investor that you've lost a huge amount of money. And that just points to the fact that if you invest over long periods of time, you make money out of the market. You know, you don't lose money in the market.
Indeed. Thank you so much for joining me.